everyone, good evening and welcome to this edition of Startup Central, India's only show that focuses on startups and entrepreneurship along with technology, innovation and disruptors. I'm Avan Dabash. Well, before we proceed, we would like to tell you that we want to know your feedback, what you want to see on the show, what you don't want to see. So do remember to keep connected with us. You can even pitch to us and who knows, you might be a part of our show. So just shoot us an email. The email ID is suc@etnow.tv. Well, let's get started then with a look at all the startup stories that are making the headlines in Fatafat mode. Workspace solutions provider Workspace has postponed their IPO, that's WeWork, and the decision will delay the plan to acquire majority control of its Indian affiliate. Reports suggest that the holding company, Embassy, will raise fresh capital to fund the company's India operations. A clutch of richly valued startups in the country will petition SEBI for a revision in the startup listing norms. Their bone of contention, the minimum promoter holding at 20%. Startups including Ola, Lenskart and Policy Bazaar feel that this norm should be either removed or should be considered on a case-by-case basis. RBI may bring payment gateways and aggregators under its direct supervision. A discussion paper suggests that these gateways come under Payment and Settlement Systems Act, and these entities entitled are critical link in the transaction flow and there is need to regulate the activities. A VC Edge report suggests that a number of early-stage deals fell to a 5-year low in the first half of 2019. In the 6 months ended June 30th, there were 193 angel and seed investments versus 312 deals same time last year. The number of deals under $5 million fell 46%, while the value of these deals fell 29%. CCI, meantime, is keeping a close watch on the issue of a deep discounting by e-commerce players. The competition regulator is looking to deal with possible anti-competitive behavior in the sector. E-commerce giants like Flipkart and Amazon are planning to launch special festive sales, which trader bodies have opposed in the past. Alright, Startup Central, Fatafa, those were all of the top stories that are making the news in the world of startups and entrepreneurship. But let's get a move on and focus in on our exclusive interaction of the day. Urban Clap is India and UAE's largest home services company that has been backed by marquee investors, the likes of Ratan, Tata, Tiger Global and SEF Partners. In fact, the company raised about $75 million in its largest ever fundraising just last month. So let's discuss the road ahead as well as the journey gone by. For this, we're joined by one of the co-founders, Abhiraj Bal, right here on Startup Central. Abhiraj, great to have you on board. Thanks so much for joining in. To begin with, let's rewind. Talk about the early days at Urban Clap. How exactly did the idea even come about?
Sure. So, the early days, we'll have to dial back to November 2014 when the company was launched. Back then, Varun, Raghav and I, one of the things that the three of us had in common was that we had moved back to India from overseas and tried to build something prior to Urban Clap. Each of us had attempted at building one startup which hadn't really worked. The common sort of theme or the common thing between the three of us was that we had actually successfully crashed and burned one startup. And so in some sense Urban Clap was our second attempt at building something meaningful. We felt very, very strongly about the problem statement of home and local services. We felt that it was a very large, gigantic industry which had remained unorganized, remained in the offline world for far too long. We spent a lot of time talking to consumers, trying to understand their pain points, and we realized that getting quality services at the right price, at a transparent price, and in a manner that is punctual, is completely missing or was missing at that point of time. And then when we actually spoke to service partners and tried to understand why this wasn't something that they were able to deliver, we realized a whole bunch of problems that they face, whether it's related to training and upskilling, or it's related to a vast majority of their margins being eaten up by the middlemen. So it was I wouldn't say it was sort of this one eureka moment when the idea struck us. It was a few months of actually spending time with consumers and service partners, trying to understand sort of what was not working.
Okay, that's an interesting start, and let's move on and talk about getting the first set of investors on board. That's always a task for startups. So how easy or difficult was it for you?
I think getting any kind of external investment into your company is not easy because in most cases investors they're sort of entrusting a fair amount of capital and responsibility onto young founders who haven't had a lot of experience building companies in the past. So especially if you're a first-time founder, I think convincing an investor is not easy. I think in our case, what sort of worked was the fact that we were attacking this gigantic industry, and our vision was that we will organize it through technology and through smart processes. And I think that, coupled with actual execution on the ground, the fact that the company had already some traction, the fact that the founders had bootstrapped the company, and it was seeing some traction and it was growing. I think those two things were what helped us get the first round of investment from SAF Partners and Axel Partners.
Okay, now you have several A-list investors. Tell us the backstory on how you got someone like Mr. Ratan Tata to back the company, and that too, that was at a very early stage of Urban Clap.
Yes, we were actually quite fortunate that Mr. Tata backed us around the time when we had completed 1 year in building Urban Clap, a little more than a year. The backstory there is that our angel investors Kunal, Behel and Rohit Bansal had successfully managed to get Mr. Tata to invest in their company Snapdeal. In fact, Snapdeal was the first startup in which Mr. Tata had invested, and I was kind of chasing Kunal to make an introduction to Mr. Tata, and he was kind enough to do that. And then we sort of went to Bombay House and met him. I distinctly remember I was actually quite amazed by how humble he was and how humble his office was, and it was a big learning for us. I remember entering into the register, my name and the person to meet is Mr. Ratan Tata, and I took a photograph of that and sort of shared it back with my family. So it was definitely one of those moments that you remember. I think Mr. Tata very quickly understood what we were trying to build. I remember his words were, keep the quality very high, and this is something that India really needs, and don't be in a hurry, give it 10-15 years at least. We were very fortunate that after that meeting, his office followed up and mentioned to us that he would like to invest. And then we met him again in Delhi, and then the investment finally happened.
Oh yes, certainly. I'm sure those must have been some memorable moments with none other than Mr. Ratan Tata. But let's talk about business as well. Can you tell us a little bit more about the term, how many active user service professionals you have? What are the expansion plans on this front?
Yeah, sure. So, at this point of time, we are doing anywhere between 700,000 to 800,000 orders per month. So these are effectively 700,000 or 800,000 homes that our service partners are entering on a monthly basis. We deliver all of these services through a highly trained, hand-picked fleet of close to 20,000 service partners who work pretty much exclusively with Urban Clap. So all of their earnings come through Urban Clap, and we work very closely with them to empower them to deliver a high quality user experience. So we provide training to them, we provide products to them, we help them with bank account opening, loans, insurance. So it's not just a technology solution, we go far beyond technology to actually enable them to become high quality professionals. So 700 to 800,000 orders delivered by 20,000 service professionals. We are in 14 cities in India right now and 2 cities internationally. We are expanding our footprint both in India as well as internationally. So by the end of this financial year, you will hopefully see us in the top 20 cities of India. And you will also see us in a couple of international markets outside of UAE, which is our first international market that we've entered. So lots of growth plans in store. The company is growing at a rapid clip. We are growing at anywhere between 150 to 200% year on year for the last 3 years, and we would like to maintain that growth rate.
Okay. Sounds good. What about your international expansion plans? What are the markets that are you going to explore? And tell us a little bit about the rule book in terms of, expanding your geography.
Yeah, so we launched our first international market, Dubai, about a year and a half back, and we took our time to sort of, there were some learnings from India that we extrapolated, but by and large, we were open to sort of re-looking at the model and solving it for the local needs of Dubai. I think Dubai has actually shaped up very well for us. We are now the #1 home services marketplace in Dubai in less than a year and a half of being live there. We've also launched Abu Dhabi about a couple of months back at the back of our success in Dubai. The next market that we are looking at right now is Australia. Australia is a market that you will see us entering before the end of the year. And that's a very interesting and exciting market for us. We'll be launching with Sydney. Again, we don't assume that the model will perfectly work. We believe that in every geography that we enter, we have to take the learnings that as a company we've built over the years, but we have to be willing to adapt locally and solve for the local needs of that geography. So once we enter Sydney, we will figure out what are the local needs, what are the categories, how should we approach it. One thing that we will definitely try to do is provide a full stack solution with, where we own the user experience. I think that's at the heart of what the company tries to do, and regardless of anywhere in the world that we might be at, that is something that we wouldn't compromise on.
Okay, that's expansion. But what about your distinct consumer trends? Tell us where they stand. What are customers increasingly looking for in terms of your service categories? I'm sure you must have observed.
Sure. So I think there are sort of 2 or 3 trends that I would say are visibly clear to us. One is that there is this entire trend that we are being a part of, which is getting things at home. I think you will increasingly see for a certain income segment, which is middle class and upper middle class, upwardly mobile, pressed for time, that they will adopt to internet solutions where things are provided to them at their home. Our large cities in India are choked from an infrastructure and traffic standpoint. There's obviously pollution, etc. So there's a growing trend of people not wanting to step out. And this isn't limited to home service. I mean, this is true for grocery. This is true for food ordering. This is true for a whole bunch of things. It certainly helps that, a lot of entertainment is also happening at home these days through Netflix. So I think that's one trend, which is, millennials and young couples and young families are wanting to stay in-house and trying to get as much as they can come to them rather than them stepping out. The second trend that we are seeing in particular with beauty is increasingly users want solutions which are a lot more sort of chemical free and organic. And there's almost this whole Indian dadi maa ke nuskhe, for the lack of a better word, coming back into the fore. So people are very particular about what they're applying on their skins. A lot of us are becoming very conscious of the fact that the products that we use or the services that we use shouldn't have chemicals in them. Single-use plastic is becoming a thing of the past. So there's consumers are becoming a lot more I would say discerning in terms of choosing and voting with their dollars on the kind of services they want. It's not just the quality of the services which should be high, it's also the fact that there is a clear trend towards organic. And the third thing that we're seeing is that people are willing to pay, probably for the first time in India, a markup for convenience. People are willing to pay in order to have an electrician come home faster or a cleaner come home faster, a slight premium, for a good quality service at a convenient time for them. I wouldn't say that premium is as high as one would see in, for example, Dubai, where we are present, and that's just a factor of disposable incomes. As the disposable incomes rise, I see this to be a larger trend.
Fair enough. Now, what about the space that you operate in? Is it a challenge maintaining consistent and high quality service? What goes really into ensuring that you maintain that kind of service quality, across the board? Because consumers in an industry that you're in can tend to be very finicky.
No, absolutely. I think, if you look at what consumers want from a service like Urban Clap, it's actually quite simple. They want a high quality service at the right price, and at a time that suits them. So if we think about those three vectors for the value that we add for our consumers, quality is largely controlled through training, as well as controlling the quality of the products that are used in the service. So we today run more than 30 training centers in the country. We have a fleet of over 100 full-time trainers, and in any given month we are training close to 3,000 service professionals. So training is a huge part of the company's focus. We also run, we also control the supply chain of consumables which might be used during the service delivery. So this could be cosmetics, this could be cleaning material, etc. And I would say these are two large areas of investment that we make to control the inherent quality of the service experience. The second is, controlling pricing. I think we are, through technology, we go to great lengths to ensure that the pricing is standardized and transparent and fixed upfront. And nothing is left to sort of imagination, or nothing is left to negotiation between you and the service professional. And the third is, I would say, our core promise, which is that the service professional will always reach on time. And this is a stark difference between, Urban Clap and the offline market, where you have to keep chasing up, after the service professional. Often they won't show up, and even if they show up, they would probably show up late. And I think that's one area where, again, through technology, we put in a lot of effort to ensure that we always show up on time.
Okay, so what are the other challenges that you may have faced while scaling up, and some of the company specific, sector specific challenges?
I think the biggest challenge would be the availability of trained and skilled manpower. India historically has been a low-skilled country, and we are operating in the very, very high-skill bucket. So the sheer number of service professionals who are skilled and trained in these different categories, whether it's plumbing, carpentry, beauty, that number is fixed, and therefore we've been early to realizing that we are not in the business of aggregating service professionals, which is that, hey, we handpick the best that are out there and bring them to the platform. We're actually in the business of upgrading and creating high quality service professionals, which means we have to invest in fundamental training, fundamental skilling, wherein even if you're a fresher who has no background in plumbing or carpentry or beauty, you can enroll in our skilling programs, and over a period of 3 to 4 months you can actually end up becoming a very high quality service professional, ready to go live on the marketplace. That's the area where the company is focusing, and that's what we see as the future. Our vision that we have defined for 2025 is to have 1 million service professionals on the platform. Now that's a tall order, and today at 25,000 we are fairly far away from that number, but we believe over the next 5 to 6 years we will be able to make fundamental investments in training, in technology, and in upskilling, and be able to sort of unlock those many jobs for India.
Okay, that sounds quite promising. Now, there's enough speculation that you're going to be a unicorn soon. So what do you think that would mean for the company?
I think valuation and tags like unicorn, etc. I mean, these are, honestly not things that we think about or worry about. These are outcome metrics. As and when they happen, it's good. But But as a company, we are far more focused in looking at the input metrics, which is, are we delivering a high quality experience for our users? Are our partners seeing phenomenal step jump in their earnings, and are they having a meaningful livelihood through the Urban Clap platform? And are we providing for a safe and high quality marketplace for society at large? And I think that's really the focus for us, and to keep making progress on that front is what we worry about, and everything else is an output metric.
What's been the biggest learning then for you as an entrepreneur as you've built up Urban Clap into the company that it is?
Biggest learning, I would say perseverance and just being at it. I think one of the things that I would say my generation is guilty of is very quickly getting bored and very quickly wanting to do different things or wanting to do new things. But the reality is that in order to build anything meaningful, it takes a lot of time, and it takes effort, and more importantly, it takes you to do the same boring things again and again and again. And I think that, for me has been the biggest learning. And now, I'm also trying to inculcate that within the company, that, you don't have to do too many different things. You just have to get better and better at doing the same thing over and over again. And over a long period of time, compounding kicks in, and then it starts getting very beautiful.
We wish you all the very best. Thanks so much for taking time out and joining in, giving us a roundup of your valuations, your plans to expand, as well as the journey so far. That's the word coming in from the co-founder of Urban Clap. Well, on that note, we slip into a quick break. Do stay with us. On the other side, we will be discussing WeWork and all the problems with respect to the IPO. Stay tuned for that on Startup Central, and do remember to pitch to us and stay connected. Welcome back. Still tuned in to Startup Central. Well, let's focus in on the WeWork IPO debacle. The workspace solution provider, Workspace rather, has postponed the IPO, and that decision is going to delay their plan to acquire majority control of the Indian affiliate. In fact, reports suggest that the holding company Embassy will raise fresh capital to fund the company's India operations. Let's take it across then to my colleague Karunya Rao to understand a little bit more about this. And Karunya, why in the first place did the company's IPO plans fail, and what is the status of some of the other tech IPOs?
Well, if you look at it, it's a $20 billion IPO which has been postponed by WeWorks, trending across waves through the industry, whether it's startup technology or even the equity markets at large. It's clearly a very big news. They plan to launch investor roadshow this week in order to garner more interest among the investor community. But because of the lukewarm response, they've essentially decided to shelve it, or not really shelve it, but definitely delay it indefinitely. The valuation also, do remember, has been slashed. Earlier, they were valuing it to be somewhere around $47 billion. They brought it down all the way to $20 billion. And despite of that, if they received a very lukewarm response, the promoters, it seems, have decided to delay it further. The company, do remember, earlier aimed to price and list the shares next week. They delayed the plans amid operating losses, corporate governance issues. These are some concerns as well which continue to be surrounding the company as we speak. The parent company, We Company, still aims to complete the flotation before the end of this year, because the parent secured a $6 billion credit from banks last month. They can only access this amount of credit if WeWork floats before the end of the year, and that's exactly why the parent company is looking to do it before the year ends. Well, what next? IPO underwriters at JP Morgan Chase and Goldman Sachs, they're testing investor appetite with a valuation further lowered somewhere between 15 to 20 billion dollars, and reports say that the valuation could be as low as 10 billion dollars as well. As far as some other IPOs which have listed in the US markets this year are concerned, they have been clearly going amok. If you look at Uber, the current market price is way below the listing price or even the IPO price as such. There's a Lyft as well, which is currently trading at 47, 48 odd rupees. The IPO price was 72. It got listed at 87 with a very, very good premium, but right now it is way off that level. Beyond Meat has soared on the other side. It did list at $46, but right now it's trading above $150 per share. Pinterest as well has soared very, very significantly. It listed at its issue price was $19. It listed at nearly $24, and right now it's $29 to $30 odd dollars. As far as WeWork is concerned, the key concerns which it is surrounded by at this point is that it's relatively easier for any other competitor to enter this market. We already know of a lot of other players also who are ramping up their presence in this segment. Any collapse in demand will also see significant struggle by the company to able to pay off their rent and pay off their landlords. Concerns about the firm's management and corporate governance standard, like I just flagged off. CEO and co-founder Adam Newman has taken $700 million out of the company right before the IPO. That's another development which triggered off a bit of a weak sentiment or a negative sentiment across the community. He also owns properties that WeWorks rents, which is also a potential conflict of interest. So a whole host of issues at this point in time surround the company. So let's see by when do they finally plan to list on the exchanges and at what valuation, because right now it doesn't look very, very encouraging as far as the concerns are there. $10 billion is as low as it could go.
Thanks much for giving us a detailed insight. In fact, let's take that discussion further. Siddharth Pal, founding capital at 341 Capital, and we also have Padmaja Ruparel, co-founder Indian Angel Network, now joining in to take this discussion forward. Padmaja, lots of reasons as to why we're seeing this overall IPO delayed, but the most glaring of them being the lack of profits. Now, while the company has argued that all of this is going into the economies of scale, the fact that, most of their locations are fairly profitable, we can't ignore the fact that you have a glaring loss of $905 million. What happens then at a time of recession, and what happens to these kind of mammoth numbers? So it's clearly a fairly justified concern.
Yes, I tend to agree with what you're saying in some ways, but see, what this is also telling us, that while a lot of money which the companies generate is going back into the economy, but the reality is that the investors and shareholders, be it listed or unlisted, are investing in the company itself. And therefore, the value of the company has to be not only sustained but grow. Only then will investors invest in a company. Second, so, if there is a loss, like you're saying, of over 900 million, then that is a big concern. The second thing, I think this is a big, big indicator that companies have to have a top line and a bottom line. It cannot just work on raising money continuously and accessing or market shares. If there is no top line and there's no profits happening and no projections to profits, no visibility to profits getting created, then this is a concern. It was a concern. It will remain a concern. So companies have to be sustainable on themselves. They have to grow or have enough profits to grow on their own. When they raise money, it is for future growth, and yet have to at that time also become sustainable. So I think this is a bit of a watershed in my mind to say that companies which are not growing, which are not building profits and just creating valuation, I think the days are getting over, and we are going to go back to the old model, which in many ways is good news, because then it will create valuable companies, sustainable companies, and create value for everybody, not only the shareholders, but it will create a lot of confidence, stability in the economy, be it for employees, be it for shareholders, founders, stakeholders. So that's how I view it.
Siddharth, wanted to get in your take. The fact that Adam Newman owns a lot of the properties that WeWork actually rents out, that would cause a conflict of interest to a great extent, as well as the fact that he recently pulled out right before the plans of the IPO something like $700 million. These are all red flags.
No, that's actually true because the public markets are very unforgiving when it comes to corporate governance. In fact, they actually place a premium on corporate governance more than anything else. Adam Newman is also notorious for the fact that he licensed the word "we" from his private holding company onto WeWorks for about $5.6 million worth of stock, a transaction that was actually reversed as well. And I also do agree with what Padmaja actually mentioned. Businesses that actually substitute revenue with capital will find the public markets very, very unforgiving. In those markets, they do demand growth quarter on quarter, and they simultaneously demand profitability or positive cash flows as well. From an IPO perspective also, it would behoove a large number of startups to actually take these factors into consideration, because while the private markets are more forgiving and more lenient when it comes to corporate governance lapses, or when it comes to matters of profitability, or when it comes to profitability of positive cash flows, the public markets are not. The public markets have been very active for a long period of time, and they define performance as well as very high standards of governance simultaneously.
What about the actual numbers then, Siddharth? WeWork lost nearly $1.9 billion last year after making sales of $1.8 billion. It loses $2 for every $1 that it generates in revenue.
No, that's true. So see, what we've seen in the world now is there's a surplus amount of capital coming into the private markets. So a large number of companies aren't concentrating on the bottom line anymore. Everyone's just looking at the top line and looking more at growth, and they're creating their own metrics of growth as well. And what we're seeing especially is a rise of a variety of companies that actually substitute revenue for capital. There's an unlimited tap of capital available from private equity investors, especially now that SoftBank has launched another $100 billion fund and it's entering the market very actively. So all the promoters of these companies also need to understand that every investor comes in with the understanding that one day they will actually earn returns on the investment they make. So the company will have to start actually returning some amount of money to the investors, either through buybacks, either through dividends, and they will have to turn cash flow positive. Because the moment the funding tap turns off, none of these actually are viable business model. So that business restructuring and business reengineering is imperative. Even in the case of WeWork especially, there's another listed entity in the US called Regus. Regus is only valued at $4 billion, whereas WeWork at its prime was valued at $48 billion. It's 1/12 the value of WeWork, yet Regus is actually profitable, and Regus is in the same business model as WeWork. WeWork had better branding, and it had a greater connect with the millennial audience. But that millennial audience at the end of the day doesn't matter for much if you keep losing $2 every $1 that you do. It's important now that WeWork actually introspects, finds out what needs to make tweaks to his business model and come up with a more viable option before they can go IPO. Otherwise, if they do IPO and it implodes, it's going to be a stain on every single startup that's actually looking at the IPO market for a viable exit, either in the US or in India or anywhere else in the world.
Yeah, absolutely, and I think the figures really tell a tale in themselves. Padmaja, what about some of the other IPOs as well that we've seen, Lyft or Uber, for instance? A lot of them as well have seen them go below the overall issue price. Is that as well a concern? Because we have seen that their plans for WeWork, at least, to list the shares met with quite an icy reception from investors.
No, again, I think if you look at a macro level, it's the same issue, right? Again, if you look at Uber, if you look at Lyft, if you look at WeWork, if you look at all of these companies, the model is very different. As Siddharth said, you cannot replace capital by profits. You have to build a top line, bottom line company. It is the only way that you can create value, and it is the only way that I think most investors that we know of, it may be a little old world, I must say, that they are the ones who will be able to see value in their growth of shares. So irrespective of these companies, I think this is very, very critical. And I strongly believe that this is a good thing to happen, because it will help entrepreneurs, it will help management to build very strong and solid companies, which will grow and sustain over a longer period of time. It will create shareholder value, and it will create very, very reliable companies which will help employees to be much more secure. So, and that to me, in the economies that, as you grow economies, that is very important. So, in short, I think this is a watershed moment, and
Yeah.
it is important. It's a very important indicator that has happened.
I want to take that point forward, Padmaja, but for a moment, let's focus in on what the news reports, Siddharth, are indicating that embassy could potentially, I mean, these are just news reports as of now, could potentially look at a fresh infusion till the company manages to get to that valuation. Do you think that that would be a lucrative option, at least now, for the Indian unit?
It would actually, because the Indian unit has been one of the drivers of growth. In fact, in the S1 filed with the SEC as well, they specifically highlighted the growth that they've actually enjoyed in India, as well as the partnership that they had with Embassy as well. So I think Embassy's partnership has actually become a model that WeWork is trying to replicate around the world. So in case WeWork's viability starts getting shaky, then it actually behooves Embassy as a joint venture partner to capitalize the Indian JV to make sure the operations actually go. Because a number of entrepreneurs have now actually gotten used to the entire WeWork environment. They have gotten used to the flexibility that WeWork actually offers, and WeWork has actually created a benchmark in India. And to see such a company that has done so much good for the entrepreneurial ecosystem to actually suffer in this particular regard is causing shivers to go down the spines of a number of entrepreneurs. So I think the WeWork has some very experienced investors on board as well. There are people who've actually put in billions and billions of dollars into the company also, and they do have joint ventures throughout the world. So they may have to look at alternate modes of funding in the interim until they can actually figure out their IPO. There are rumors that they are planning on going back to SoftBank, that they are actually reaching out to several other private equity investors, doing a down round to keep everything going. I think the moment you enter the private markets, it's important to understand that everything that you had under wraps is now going to be open. All your books are going to be open. Everybody can actually see how your profit and loss actually grows, what your expenses are, whether you are a viable business or not. So it's a very calculated move that they should make as of now, and they should actually take this moment to introspect, recapitalize, build a much stronger and more viable franchise. More importantly, that doesn't just rely on external capital, but can actually grow on internal cash accruals, and the public markets will actually welcome them with open arms after that.
Absolutely. I mean, we've seen some of the companies as well back home go belly up, and it's only investors that are at the receiving end of this. So better, catching all of these alarming signs early rather than it being too little too late. Padmaja, I just wanted to talk about what Siddharth brought up in terms of now the company recalibrating, just re-strategizing in order to get this IPO back on track. What do you think could be their options at hand? Any sort of help from embassy? He said they were looking to revisit those talks with SoftBank. What could now be the options at hand? Because those corporate governance issues, the losses that the company has, they are continuing to remain a forefront.
No, I think what Siddharth said is very right. I think the company will have to first clean up corporate governance and compliance. It's imperative, number one. Number two, I think it will have to relook at its model and pivot, because obviously the market share model where they're raising capital in place of profit, that's not working, and no surprises there. Number three, I think there is clear consolidation strategy that they will have to think through, and that may result in some kind of a minor or major pivot. But ultimately, I think they will have to move to a model where they are creating profits, it's sustainable, growing on its own steam, and they're raising capital for inorganic growth. That is how I see this playing out.
Okay, fair enough. Now, Siddharth, let's just talk about what kind of a message this sends to some of the other companies as well. There's so many of them that are looking to IPO over the next few years, but this sort of stringent message to clean up the books, to actually get everything out in the open, be transparent, corporate governance issues out the way, is definitely sending out a positive signal to some of the other companies, not just globally, but back home as well.
It is actually. I think this moment should be taken by everyone as a wake-up call that the gravy train of free capital, free and surplus capital flowing into them does actually have an expiration date. And the moment the music actually stops, and everyone has to pick their particular chairs, that's when everyone realizes what they actually have in hand. So I think a number of businesses, a number of promoters and founders, in fact, are actually sending furious messages on various forums, etc., actually saying that they do need to revisit the entire business model as of now, because in case they do plan on IPOing, the strong business fundamentals that have actually driven the IPO market for the past 50 to 60 years is the kind of tune that all these companies will have to dance to. Regardless of whether they're a tech company, they're an AI-driven company, they're a high-tech company, machine learning, anything that they have to do, the business model at the end of the day will have to generate positive revenues and positive cash flows and profits. Whether these profits are reinvested back into the business is a business decision, but they need to be cash flow positive at least. I think this everyone's now going to start looking, instead of being seduced by these high growth rates and everything by that's caused by burning so much capital. People are now going to start looking at a more sober approach where they don't mind sacrificing some amount of growth for positive cash flows into a business. So there is viability that has to be built in. This viability is something that's going to be essential for all startups. Otherwise, what will happen is when the market overheats and in case the capital taps actually turn off, a number of these businesses are going to collapse and the ripple effect throughout the economy is going to be massive. It's important for people to take positive steps to prevent this from happening. And WeWork, if you ask me, is actually the canary in the coal mine when it comes to this, because they've actually shown the rest of the world that the public markets are extremely unforgiving when it comes to these particular hygiene matters. And all these people do actually need to get their house in order before they actually approach them.
Yep, get the house in order before it's too late. And as you said, the public markets are unforgiving. This does create quite an example for some of the other companies. Thank you so much, Padmaja, as well as Siddharth, for taking time out and joining in to talk about the listing wars for WeWork. So it is imperative, of course, to have an airtight business model, get your financials in order before actually looking at the primary markets. Tell you what, we slip into a very quick break. Do stay with us. On the other side, lots more coming up. Great to have you back with us. This is Startup Central. Let's shift focus then to our continuing consumer special segment. Now, festivals are around the corner, the festive season, and a lot of companies are coming out with a lot of special deals and discounts in order to lure customers. Amazon, for instance, has launched its biggest fulfillment center in Mumbai. My colleague Neha Tyagi visited the facility and spoke to the company's Vice President of Customer Fulfillment, Akhil Saxena. Here's a special report.
This is the largest fulfillment center that we have in the state of Maharashtra. Okay. This is spread out over a footprint of 2.7 lakh square feet and has a storage capacity of 1.5 million cubic feet. Okay. If you look at it at a national level, we have more than 50 fulfillment centers, and the total cube that we have for storage is about 25 million cubic feet of storage space. This is important for us in the state of Maharashtra because we have seen a lot of growth for our sellers in Maharashtra and also the customer orders from Maharashtra. Out of the 5 lakh sellers that we have on our marketplace, almost 70,000 sellers are from Maharashtra. Okay. And therefore, by building this fulfillment center close to our seller base, we have provided them the infrastructure where they can bring in their inventory. Sure. And this is ahead of the festive season. So this is a time when most sellers bring in their unique selection, the new items that they want to sell, and we have built this capacity so that they can bring in selection well ahead of the festive season.
Could you give us an understanding of the kind of SKUs or products that typically sell more during the festive season?
This is a time when we see a lot of sales of smartphones, consumer electronic items, consumer durables, large appliances, TV, washing machines, refrigerators. This is a time when a lot of people want to buy for fashion items, whether it is apparel, whether it is shoes, bags. And then this is also a time when people buy a lot of stuff for their homes and kitchens and consumables. So I think we have the opportunity and to serve all our customers across their requirements, across the entire selection. It's like think about it like the everything store for our customers. That's what we aspire for.
Sure. So on a typical day, if you're seeing 100 orders, it sort of magnifies when the festive season comes in. So how are you prepared in a scenario like that to handle that kind of volume of order, and how do you maintain the delivery time then?
So we do multiple things. First of all, to create the infrastructure ahead of the demand.
Okay.
So you have seen that we have built the fulfillment center. We have enough
Sure.
capacity. We have shown you the lines which are
Yeah.
right now not being run, but as soon as the orders come in, the lines will be there and they will
Sure.
be up and running. So we have built the infrastructure. Then we have to train the people. So you
Okay.
saw people being trained in the
Sure.
room there.
Sure.
So we are training the people, training them on the processes so that they
Okay.
can, when they have the orders to process, they will be doing a good job there.
Okay.
Then we have built a transportation network also. We have completely built out both middle mile as well as a last mile transportation
okay.
network, so that it is a full value stream from origin to the destination where we can serve the customers well.
Okay.
And then we do the testing of the systems to say software, we look at capacity. So we do stress tests in the fulfillment centers to see whether the systems can take those orders at that scale, and we feel confident that we will be ready for our customers.
So you said that you have added infrastructure in order to deal with the festive season, which will start on the 29th midnight. Can you give us an understanding of, in terms of logistics or warehouses, how many additions have we seen in terms of transport, or maybe can we see more warehouses sort of coming in?
So I'll talk about transportations. So if you look at transportation, there's middle mile, which connects from one city to another city, and then there is the last mile. So on the middle mile, we have doubled the number of trucks. So right now, on an average, we see about 10,000 trucks that Amazon is running now for Amazon shipments and from inbound. Then we have also doubled the number of partners who are helping us as vendor partners for the transportation assets. They could be asset owners or they could also be asset aggregators. In terms of the air capacity, because we often fly shipments from one city to another, we have increased that capacity from last year by about 1.6 times. So we have partnered with existing airlines that we were working with, and we have also added capacity by going to new airlines. So we have also enhanced and beefed up that network. On the last mile space, we have doubled our service partner network program, the delivery service partners. So we had about 700 delivery stations being managed by them. Now we have about 1400 delivery stations, and we now, instead of the 500 cities that they were serving us, now we have 750 cities that our service partners are going to serve for us. So we have expanded that capacity. Then we have launched the Flex program, as you know, the Amazon Flex, which is an app-based program for people who want to work part-time and deliver packages for Amazon. So we launched that program in 4 cities. We saw so much of goodwill and so much of uptake for the program that we now have expanded it to 7 cities. So we have built the Flex program. Similarly, the IHS, the I Have Space program, where we work with the Kirana stores. We had about 20,000 stores for last Diwali. This year we will have about 23,000 stores. So we are excited by that scale up as well. So different parts of our last mile and middle mile transportation have been beefed up. In addition, we have also added more sortation centers. So we had about 13 states, we had sortation centers. Now we have about 18 states where we have our sortation centers, and that is going to add to the speed of the network so that we can move the shipments faster to the customer.
So could you give us an understanding of how much time does it take to process an order, say from inbound to outbound, the whole processing in between? And when you're looking at a festive season and an event as huge as that, by how much does that time sort of go down by?
I think it's a function of what kind of order it is. So if it's a brand new phone which has been launched, we will see that the phone is dispatched from receive to ship out in a couple of minutes sometimes. So it's a matter of what is selling, and like flash sales, for example, we ship it out very fast. We have built enough capacity for same day delivery, next day delivery, order by 1 a.m. and get it by 11 a.m. in multiple cities. So I think we have built the network and we have built a processing capacity using technology so that we can process our orders very fast.
So just last question, while we are going to see the Great Indian Festival sale, we also have competitors who are going to come up with their own sales during the same time. How do you differentiate, and in what capacity, in what areas do you have an edge over them?
I would like to remain focused on my customers, and I would like to do the right things for them. Our customers are both sellers and buyers, people like you and me who are buying on Amazon, and sellers who want to sell on Amazon. So to build the right infrastructure so that they have a great experience both on the seller side as well as the customer side, and also to ensure that they have a very convenient shopping experience, they have an experience that is trustworthy, and they have an experience which brings them a wide selection at the right pricing. I think that's what we are focused on.
And as we wrap it up right here on Startup Central, in a fast-paced world and even faster internet speeds, fake news tends to spread far and wide, which can have huge repercussions, especially when it comes to our health. On a mission to bust fake news and tips, Goki India Health Quiz, partnered with the Times Network, has launched an app to equip each and every one with the right facts and information regarding health, fitness, nutrition, sleep, stress, and so on. So be a part of this 100-day initiative through an exciting quiz format that will educate and give you a chance to win exciting prizes.